Question 1. Which of the following best describes the primary purpose of the Securities Investor Protection Corporation, SIPC? A. To regulate the securities markets and protect investors against fraud. B. To protect customers against losses resulting from broker-dealer insolvency. C. To provide insurance for bank deposits up to a specified limit. D. To supervise the conduct of broker-dealers and their associated persons. Answer: B. To protect customers against losses resulting from broker-dealer insolvency. The Securities Investor Protection Corporation, SIPC, safeguards customer accounts at broker-dealers in the event the firm fails financially. It protects against the loss of cash and securities up to $500,000, with a maximum of $250,000 for cash, ensuring investors recover their assets even if their brokerage firm goes out of business. Unlike the Federal Deposit Insurance Corporation, FDIC, which covers bank deposits, SIPC specifically covers securities accounts. Remember, SIPC protects against broker-dealer failure, not against market losses or poor investment performance. Question 2. An investor seeking a security that represents ownership in a company and typically offers voting rights would most likely purchase which of the following? A. A corporate bond. B. A municipal bond. C. Common stock. D. Preferred stock. Answer: C. Common stock. Common stock represents equity ownership in a corporation, giving shareholders a claim on the company's assets and earnings, along with significant voting rights on corporate matters such as electing directors. While preferred stock also represents ownership, it typically does not come with voting rights and offers fixed dividend payments. Bonds, whether corporate or municipal, represent debt that must be repaid, not ownership. Common stock is the fundamental security for direct company ownership and shareholder influence. Question 3. A new issue of corporate stock is being sold to the public for the first time. In which market would this transaction occur? A. The secondary market. B. The third market. C. The primary market. D. The fourth market. Answer: C. The primary market. The primary market is where new issues of securities are sold to the public for the very first time, allowing companies to raise capital directly from investors. This process is often facilitated by investment banks in an underwriting syndicate. Once these securities are sold in the primary market, any subsequent trading between investors occurs in the secondary market. Think of the primary market as the first sale of a security. Question 4. Which of the following is considered an associated person of a FINRA member firm? A. A clerk performing only administrative duties. B. A registered representative. C. An attorney providing legal advice to the firm. D. A consultant hired for a one-time project. Answer: B. A registered representative. An associated person is generally an individual who is engaged in the investment banking or securities business and is directly or indirectly controlled by a FINRA member firm. This specifically includes registered representatives who solicit, buy, or sell securities, or supervise such activities, requiring them to be registered with FINRA. While other individuals may work for the firm, only those involved in the securities business, like a registered representative, are considered associated persons for regulatory purposes and must adhere to FINRA rules. Question 5. All of the following are typically considered money market instruments except A. Treasury bills. B. Commercial paper. C. Corporate bonds. D. Certificates of deposit, CDs. Answer: C. Corporate bonds. Money market instruments are short-term, highly liquid, and relatively safe debt instruments that mature in 1 year or less. Treasury bills, commercial paper, and certificates of deposit, CDs, all fit this description, serving as popular vehicles for short-term borrowing and lending. Corporate bonds, on the other hand, are long-term debt instruments that typically mature in more than 1 year and are therefore considered capital market instruments, not money market instruments. Question 6. What is the main characteristic that distinguishes an open-end management company, mutual fund, from a closed-end management company? A. Open-end funds trade on exchanges, while closed-end funds do not. B. Open-end funds issue a fixed number of shares, while closed-end funds continuously issue new shares. C. Open-end funds can continuously issue new shares and redeem existing shares, while closed-end funds have a fixed number of shares that trade on exchanges. D. Open-end funds are always passively managed, while closed-end funds are always actively managed. Answer: C. Open-end funds can continuously issue new shares and redeem existing shares, while closed-end funds have a fixed number of shares that trade on exchanges. The key difference lies in their capital structure and trading mechanism. Open-end funds, commonly known as mutual funds, continuously offer new shares and redeem existing shares directly with the fund, meaning their share count fluctuates based on investor demand. Closed-end funds, in contrast, issue a fixed number of shares through an initial public offering, IPO, and then trade on secondary markets like stock exchanges, similar to regular stocks. This means their price can fluctuate based on supply and demand, potentially trading above or below their net asset value, NAV. Question 7. Which of the following entities is primarily responsible for the regulation of municipal securities? A. The Securities and Exchange Commission, SEC. B. The Financial Industry Regulatory Authority, FINRA. C. The Municipal Securities Rulemaking Board, MSRB. D. The Federal Reserve Board. Answer: C. The Municipal Securities Rulemaking Board, MSRB. The Municipal Securities Rulemaking Board, MSRB, is the primary self-regulatory organization, SRO, responsible for establishing rules for municipal securities dealers and municipal advisors. While the SEC enforces MSRB rules and FINRA enforces MSRB rules for broker-dealers, the MSRB itself creates the rules governing the municipal bond market. This specialized board ensures fair and efficient practices within this unique sector of the capital markets. Question 8. An investor purchasing a bond at a discount and holding it to maturity will realize a gain from the difference between the purchase price and the bond's par value. This gain is referred to as A. Capital gain. B. Interest income. C. Market discount accretion. D. Discount yield. Answer: C. Market discount accretion. When a bond is purchased at a price below its par value, a discount, and held until it matures, the investor receives the full par value at maturity. The difference between the discounted purchase price and the par value at maturity is recognized as a gain through a process called market discount accretion. This accretion increases the bond's cost basis each year until it reaches par at maturity, and the gain is treated as ordinary income for tax purposes. This is distinct from interest income, which is the periodic coupon payments. Question 9. An investment that pools money from many investors to purchase a diversified portfolio of real estate or real estate-related assets is known as A. Exchange-traded fund, ETF. B. Hedge fund. C. Real estate investment trust, REIT. D. Private equity fund. Answer: C. Real estate investment trust, REIT. A real estate investment trust, REIT, is a company that owns, operates, or finances income-producing real estate. REITs allow individuals to invest in large-scale income-producing real estate properties, such as apartments, shopping centers, and office buildings, without directly owning the property. They are typically publicly traded, offering liquidity, and are often compared to mutual funds for real estate due to their pass-through income structure. Question 10. The Federal Reserve Board, FRB, can influence the money supply through all of the following except A. Setting the discount rate. B. Conducting open market operations. C. Changing the reserve requirement. D. Adjusting the federal budget. Answer: D. Adjusting the federal budget. The Federal Reserve Board, FRB, is the central bank of the United States and has several tools to influence the money supply and credit conditions, which are primarily monetary policy tools. These include setting the discount rate, the rate at which banks borrow from the Fed, conducting open market operations, buying and selling U.S. government securities, and changing the reserve requirement, the percentage of deposits banks must hold in reserve. Adjusting the federal budget, which involves government spending and taxation, is a fiscal policy tool controlled by Congress and the President, not the Federal Reserve. Question 11. An investor is concerned about the potential for their investment to lose value due to a general decline in the overall market, unrelated to the specific company's performance. This type of risk is known as A. Business risk. B. Financial risk. C. Liquidity risk. D. Systematic risk. Answer: D. Systematic risk. Systematic risk, also known as market risk or non-diversifiable risk, is the risk inherent to the entire market or market segment. It is caused by external factors such as interest rate changes, inflation, geopolitical events, or economic recessions that affect all investments, regardless of the individual company's specific performance. This risk cannot be eliminated through diversification because it impacts the entire market. Question 12. Which of the following regulatory bodies is responsible for enforcing federal securities laws and regulating the securities industry, including requiring registration of broker-dealers and exchanges? A. Financial Industry Regulatory Authority, FINRA. B. Securities and Exchange Commission, SEC. C. Department of Treasury. D. State Securities Regulators, Blue Sky Laws. Answer: B. Securities and Exchange Commission, SEC. The Securities and Exchange Commission, SEC, is the primary federal regulatory agency responsible for protecting investors, maintaining fair, orderly, and efficient markets, and facilitating capital formation. It enforces federal securities laws, including the Securities Act of 1933 and the Securities Exchange Act of 1934, and requires registration of various market participants such as broker-dealers, investment advisors, and securities exchanges. While FINRA regulates the day-to-day conduct of its member firms, the SEC is the overarching federal authority. Question 13. What is the primary purpose of a capital market? A. To provide short-term financing for corporations and governments. B. To facilitate the trading of commodities and derivatives. C. To provide a market for long-term financing through bonds and stocks. D. To enable banks to lend to each other overnight. Answer: C. To provide a market for long-term financing through bonds and stocks. The capital market is where long-term funds are raised and invested, primarily through the issuance and trading of stocks and bonds. This market allows corporations and governments to obtain capital for long-term projects and growth, while investors seek long-term returns. In contrast, the money market deals with short-term borrowing and lending. Question 14. An associated person must complete the regulatory element of continuing education how often? A. Annually. B. Every 3 years. C. Every 5 years. D. Only upon initial registration. Answer: B. Every 3 years. Associated persons, including registered representatives, are required to complete the regulatory element of continuing education within 120 days of their second registration anniversary and every 3 years thereafter for as long as they remain registered. This requirement ensures that registered individuals stay updated on industry rules, regulations, and ethical standards. It's a key part of maintaining professional competence and compliance within the securities industry. Question 15. A customer opens a cash account at a broker-dealer. This type of account requires the customer to A. Maintain a minimum balance at all times. B. Pay for all purchases of securities in full. C. Pledge securities as collateral for loans from the firm. D. Execute trades only through a designated registered representative. Answer: B. Pay for all purchases of securities in full. A cash account is the most basic type of brokerage account, where the customer is required to pay for all securities purchases in full by the settlement date without using margin. This means there is no borrowing from the broker-dealer to finance transactions. In contrast, a margin account allows customers to borrow money from the broker-dealer using eligible securities as collateral. Question 16. What is the purpose of blue sky laws in the securities industry? A. To regulate interstate offerings of securities. B. To require federal registration of securities and broker-dealers. C. To protect investors from fraud at the state level. D. To establish uniform national standards for securities sales. Answer: C. To protect investors from fraud at the state level. Blue sky laws are state securities laws designed to protect investors from fraudulent sales practices and schemes. Before the federal securities laws, unscrupulous promoters would try to sell investors a piece of the blue sky, referring to worthless investments. These state laws require the registration of securities, broker-dealers, and agents within each state to prevent such fraud. Always remember that both federal and state laws govern the securities industry. Question 17. The term public offering price, POP, is most commonly associated with which type of investment company? A. Closed-end fund. B. Exchange-traded fund, ETF. C. Unit investment trust, UIT. D. Open-end fund, mutual fund. Answer: D. Open-end fund, mutual fund. The public offering price, POP, is a term specifically used for open-end funds, or mutual funds. It is the net asset value, NAV, per share plus any applicable sales charges. Mutual funds are continuously offered, and investors buy shares directly from the fund at this POP. Closed-end funds and ETFs, on the other hand, trade on exchanges like stocks, and their market price is determined by supply and demand, not a calculated POP. Question 18. An analyst studying the overall health of the economy might look at indicators such as the Consumer Price Index, CPI, Gross Domestic Product, GDP, and unemployment rates. These are examples of A. Company-specific metrics. B. Economic forecasts. C. Macroeconomic factors. D. Microeconomic factors. Answer: C. Macroeconomic factors. Macroeconomic factors are broad economic conditions that affect the entire economy, such as inflation, measured by CPI, economic growth, measured by GDP, and employment levels, unemployment rates. These factors influence the overall investment environment and the performance of various asset classes. In contrast, microeconomic factors relate to specific industries, companies, or individuals. Understanding these big-picture indicators helps investors gauge market sentiment and potential investment opportunities. Question 19. If an investor holds a bond with a fixed interest rate and inflation begins to rise rapidly, which of the following risks are they primarily exposed to? A. Liquidity risk. B. Interest rate risk. C. Purchasing power risk. D. Reinvestment risk. Answer: C. Purchasing power risk. Purchasing power risk, also known as inflation risk, is the risk that the returns from an investment will not keep pace with inflation, causing the investor's purchasing power to decline. If inflation rises, the fixed interest payments received from a bond will be worth less in real terms over time, eroding the value of the investment. This is a crucial risk for fixed-income investors to consider, as their nominal returns may not reflect their real, inflation-adjusted returns. Question 20. Which of the following best describes the role of a prime broker? A. An investment bank that underwrites new securities issues. B. A large broker-dealer that offers a bundled package of services to hedge funds and other institutional clients. C. A broker-dealer that specializes in executing trades for retail investors. D. A firm that manages a portfolio of various investment strategies for high-net-worth individuals. Answer: B. A large broker-dealer that offers a bundled package of services to hedge funds and other institutional clients. A prime broker is typically a large investment bank or broker-dealer that provides comprehensive services, including securities lending, cash management, trade execution, and operational support, primarily to hedge funds and other institutional clients. This allows the client to consolidate many of their trading activities with one firm while still executing trades through multiple executing brokers. It streamlines operations for sophisticated investors and helps manage their complex portfolios. Question 21. Which of the following statements about Treasury bills, T-bills, is true? A. They pay interest semi-annually. B. They are issued with maturities of 1 to 10 years. C. They are quoted on a discount yield basis. D. They are subject to state and local income tax. Answer: C. They are quoted on a discount yield basis. Treasury bills, T-bills, are short-term debt instruments of the U.S. government, maturing in 1 year or less, and are typically issued at a discount to their par value. Instead of paying periodic interest, the return to the investor is the difference between the discounted purchase price and the par value received at maturity, hence they are quoted on a discount yield basis. T-bills are exempt from state and local income taxes, though they are subject to federal income tax. Question 22. What is the main difference between an option and a stock? A. Options represent debt, while stocks represent equity. B. Options are derivative securities, while stocks are underlying assets. C. Options have unlimited life, while stocks have finite life. D. Options pay dividends, while stocks do not. Answer: B. Options are derivative securities, while stocks are underlying assets. An option is a derivative security, meaning its value is derived from the price of an underlying asset, which is often a stock. It gives the holder the right, but not the obligation, to buy or sell the underlying asset at a specified price within a certain timeframe. A stock, on the other hand, represents direct ownership in a company and is the underlying asset itself. Stocks have an indefinite life and can pay dividends, while options have a limited lifespan and do not pay dividends. Question 23. A broker-dealer that executes trades for clients but does not provide investment advice or analysis is typically referred to as A. Full-service broker-dealer. B. Discount broker-dealer. C. Investment advisor. D. Clearing firm. Answer: B. Discount broker-dealer. A discount broker-dealer primarily focuses on executing trades for clients at a lower commission rate, without offering investment advice, research, or personalized financial planning. They cater to investors who prefer to make their own investment decisions. In contrast, a full-service broker-dealer provides a wide range of services, including advice, research, and comprehensive financial planning, along with trade execution. Question 24. What happens to the money supply when the Federal Reserve sells U.S. government securities in the open market? A. The money supply increases. B. The money supply decreases. C. The money supply remains unchanged. D. The effect on the money supply is unpredictable. Answer: B. The money supply decreases. When the Federal Reserve sells U.S. government securities in the open market, it takes money out of the banking system. The purchasers of these securities pay the Fed, reducing the amount of cash reserves held by commercial banks. This decrease in bank reserves limits their ability to lend, thereby contracting the overall money supply in the economy. This action is typically used by the Fed to combat inflation by tightening credit. Question 25. Which of the following is most accurately defined as the process by which a municipal bond's discount is amortized over its life, reducing the bond's cost basis each year? A. Accretion. B. Amortization. C. Capital gain. D. Yield to maturity. Answer: B. Amortization. For municipal bonds purchased at a premium, above par, the premium must be amortized, or written down, over the bond's life, reducing the cost basis. This process is called amortization. Conversely, if a municipal bond is purchased at a discount, the discount is accreted, written up, increasing the cost basis. Amortization is the process of reducing the cost basis for a bond bought at a premium, while accretion applies to bonds bought at a discount.